Welcome to Realty Rookies, your ultimate guide to navigating the exciting world of real estate. Whether you're buying, selling, or just curious, we've got the tips, tricks, and insider knowledge to help you succeed in your real estate journey. Investing in real estate is a crucial step towards achieving financial growth and stability. Whether you're a seasoned investor or just starting out, the real estate market offers a plethora of opportunities to build wealth over time. However, not all properties are created equal when it comes to investment potential. In this video, we will delve into the topic of the worst houses to buy as investment properties, and explore the importance of choosing the right properties for investment. Choosing the right properties for investment is paramount to success in the real estate market. The wrong choice can lead to financial setbacks and missed opportunities for growth. It's essential to conduct thorough research and due diligence before making any investment decisions. By understanding the potential risks and pitfalls of investing in the wrong houses, you can avoid costly mistakes and maximize your returns. Investing in the wrong houses can result in various challenges, such as low rental income, high maintenance costs, and difficulty finding tenants. These factors can significantly impact your bottom line and hinder your ability to generate a positive cash flow. Additionally, investing in properties with structural issues or located in undesirable neighborhoods can further exacerbate these challenges, making it difficult to recoup your investment. Stay tuned as we explore the worst houses to buy as investment properties and provide valuable insights to help you make informed investment decisions in the real estate market. Location, location, location. When it comes to investment properties, the significance of location cannot be overstated. The location of a property plays a crucial role in determining its value and rental income potential. A prime location can attract higher property values and rental rates, while a less desirable location may struggle to generate returns on investment. The location of a property impacts its value and rental income potential in several ways. Properties in desirable neighborhoods with good schools, amenities, and low crime rates tend to command higher prices and attract quality tenants willing to pay premium rents. On the other hand, properties in areas with declining property values or high crime rates may struggle to appreciate in value and attract reliable tenants. For investors, it's essential to avoid areas with declining property values or high crime rates, as these factors can negatively impact the long-term profitability of an investment property. Conducting thorough research on the local market trends, crime rates, and economic indicators can help investors identify areas to avoid and mitigate potential risks. To choose the right location for investment properties, investors should consider factors such as proximity to employment centers, schools, public transportation, and amenities. Additionally, analyzing historical property values, rental rates, and vacancy rates in the area can provide valuable insights into the potential returns on investment. By carefully evaluating the location of a property, investors can maximize their chances of success in the real estate market. Property condition and maintenance. When it comes to investment properties, the condition and maintenance of a property are critical factors that can significantly impact its long-term success and profitability. Buying houses in poor condition or with costly maintenance issues can pose serious risks to investors and hinder their ability to generate returns on investment. Investing in properties in poor condition or with costly maintenance issues can lead to a range of challenges, including high repair costs, extended vacancy periods, and difficulty attracting quality tenants. Properties that require extensive repairs or renovations can quickly eat into your budget and delay your ability to start generating rental income. Additionally, neglecting maintenance issues can result in further deterioration of the property and decrease its overall value over time. To assess property condition and estimate repair costs, investors should conduct a thorough inspection of the property before making any purchase decisions. Hiring a professional inspector can help identify potential issues and provide an accurate estimate of repair costs. It's also essential to factor in ongoing maintenance costs when calculating the potential returns on investment. Neglecting maintenance can have a significant impact on property value and rental income. Properties that are poorly maintained are less attractive to tenants and may command lower rental rates. Additionally, neglecting maintenance can lead to costly repairs down the line and decrease the overall value of the property. By prioritizing property condition and maintenance, investors can protect their investment and maximize their returns in the long run. Market trends and analysis. Market trends and analysis play a crucial role in making informed investment decisions in the real estate market. Understanding how market trends can affect property appreciation and rental demand is essential for investors looking to maximize their returns and mitigate risks. Market trends can have a significant impact on property appreciation and rental demand. Factors such as supply and demand dynamics, interest rates, economic conditions, and demographic shifts can influence property values and rental rates in a given market. By staying abreast of market trends, investors can identify opportunities for growth and make strategic investment decisions. Conducting thorough market research before buying investment properties is key to success in the real estate market. Investors should analyze local market conditions, property values, rental rates, vacancy rates, and economic indicators to assess the potential returns on investment. By understanding the market dynamics, investors can make informed decisions and identify properties with strong investment potential. When evaluating potential investment houses, investors should watch out for key market indicators such as job growth, population growth, infrastructure development, and neighborhood revitalization efforts. These indicators can provide valuable insights into the future growth potential of a market and help investors identify properties that are likely to appreciate in value and attract quality tenants. By leveraging market trends and analysis, investors can position themselves for success in the competitive real estate market. Financial considerations. When buying investment properties, it's crucial to carefully consider the financial aspects to ensure a successful and profitable investment. Understanding the risks of over-leveraging and the importance of financial stability is essential for investors looking to build a sustainable real estate portfolio. Over-leveraging, or taking on too much debt, can expose investors to significant risks, especially in times of economic downturn or market fluctuations. Maintaining financial stability by having a healthy cash reserve, manageable debt levels, and a diversified investment portfolio can help investors weather unforeseen challenges and protect their long-term financial goals. Calculating potential returns on investment and assessing cash flow are key components of making informed investment decisions. Investors should consider factors such as rental income, operating expenses, property appreciation, and potential tax benefits when evaluating the profitability of an investment property. Conducting a thorough financial analysis can help investors determine whether a property aligns with their investment goals and risk tolerance. When it comes to financing investment properties, investors have a range of options to consider, including traditional mortgages, private lenders, and partnerships. Each financing option comes with its own set of advantages and considerations, so it's important for investors to explore different strategies and choose the one that best fits their financial situation and investment objectives. By carefully evaluating the financial aspects of buying investment properties and implementing sound financial strategies, investors can set themselves up for success in the competitive real estate market. Conclusion. In conclusion, when it comes to investing in real estate, avoiding the worst houses for investment is crucial for long-term success and profitability. By considering key factors such as location, property condition, market trends, and financial considerations, investors can make informed decisions and maximize their returns on investment. To recap, it's essential to choose properties in prime locations with strong rental demand and appreciation potential. Assessing property condition and maintenance needs, conducting thorough market research, and evaluating financial aspects are critical steps in identifying investment properties with strong growth potential. We encourage viewers to conduct thorough research, seek professional advice, and leverage the insights shared in this video to make informed investment decisions. By staying informed and proactive, investors can mitigate risks and position themselves for success in the competitive real estate market. Take action today by subscribing to our channel, liking this video, and sharing it with others who may benefit from this valuable information. Stay tuned for more insightful content on real estate investing and financial growth. If you enjoyed this video, give us a thumbs up and share it with your friends. And remember, we're here to help you every step of the way. See you next time on Realty Rookies, where your real estate adventure begins.